Emira Property Fund has had to contend with high interest rates and general market uncertainty. Despite this, it's delivered an 11.5% rise in distributable earnings and a 20% jump in its total dividend. However, it's said that the 12-month financial period can't be directly compared to the previous 9-month year. Joining me now for further analysis on this disconnect is company CEO Geoff Jennett. Thank you so much for your time, Geoff. Of course, we know the move that you had in terms of changing your financial year end. So, of course, during this financial year, it had 3 more months than the prior period, so not really comparable. So how would you actually characterize your performance in this financial year?
So the best way I see to do this is you've got to set yourself targets for the 12-month period, and then you measure yourself against those targets. And so on the operational side, if you look at where our vacancies were last year, we were sitting at 4.7%. On our commercial portfolio, we're sitting at 4.1%. There's a strong number. If you look at on the distributable income per share side, we had set ourselves a target of 118.49 cents, and we achieved 119.03 cents. So there's a good measure. And there were reasons why that on a like-for-like basis, that the increase was only 11%. And that was the items that we flagged a year ago, in that we would no longer accrue for the Inani income. We had disposed of or anticipated disposing of the high-yielding Inuka, which was a strategic disposal, so we lost that income. And then also bearing the effects of having higher interest rates on our 6 billion rand debt, on our 42% loan to value, and all of that was anticipated. But as I say, we set ourselves a target of 118.49, and we achieved 119.03. So that tells you that we are on track in terms of what we had set ourselves to achieve.
Well, here's something you don't really expect. Your local portfolio there saying that it provided a robust operational performance that actually even exceeded your expectations. How is that in this difficult economic environment?
Yeah, so I think that's from just the way we operate our portfolio. We spend a lot of money on it. We do take action earlier than probably some other players do. We look after our tenants. And if you do that consistently enough, and we've got a good team, and then, of course, a little bit of luck, you're likely to then be able to be in a position where things did turn out better. And an important measure under that is that when we started the year last year, we anticipated that load shedding would be much more significant. But if I look at it, and our budget-wise, we were anticipating having diesel spend of anywhere between 50 and 100 million, and we ended up spending only about 25 million, of which 87% you recover from your tenants. But that's a sign that, operationally, you're doing well. And as I say, particularly the last few months, we've been blessed in terms of not having so much load shedding.
Yeah. Well, and actually, I understand the proactive measures that you've done there also to protect your retailers in that portfolio. But would you say that your South African portfolio is on a solid footing, even with office that has had quite a difficult period for the last few years?
We've definitely improved. So under the offices side, our offices improved from a 12% level of vacancy down to 10%. We've done 3 meaningful office lets of over 1,000 squares. We haven't done that for quite a while. So you can sort of see that. And really the star performer was actually on our industrial portfolio, which our vacancies on the industrial sector dropped down to 0.7%. That means 28 of our 32 buildings are 100% let. That's not usual. So that's certainly a good sign, and that's a good momentum to have achieved. So yeah, South African-wise, portfolio performed well.
Yeah. Well, talking about momentum, because I do understand that your U.S. indirect portfolio also thrives on the strong U.S. economy. But we have seen a slight slowing down in that economy. And I'm wondering if in any way it is starting to filter through to that portfolio or not.
So it hasn't impacted us yet. Last year, we did have 2 tenant failures, which were unexpected, but that's the life in that a 2.5% vacancy increased to 3.6, still pretty good. So that's just the life and the procedure in terms of what happens, and particularly in the US. But we have seen meaningful growth taking place on the ground. And when you've got between 1% and 3% growing consistently in the US, it certainly filters through to what's happening on the ground. The other part too is inflation. Inflation is still stubbornly high, and that's probably why interest rates are still at their higher levels. And with inflation, you get your rentals will increase. In the US, it's a little bit different. You've got fixed contractual rentals, but when that space comes available again and the tenant leaves, doesn't exercise their option, you get positive reversions. We were fortunate enough to have pretty much 6% positive reversions on this little bit of space that did come through. So that's telling you on the ground that there is certainly appetite for good space and people are willing to pay up for that space.
Well, let's talk about debt because it is one of the financial metrics that investors really sift through and dissect for property companies. I do understand that your loan to value ratio actually did reduce. How much more room do you have with that? But also looking at your finance costs, as much as your loan to value ratio did reduce, are you still experiencing significant pressure, and do you expect that to kind of be sticky for at least the short term?
So as we flagged last year, we anticipated interest rates to rise, and then so there's always a lag effect. Interest rates take place, and then you've got to incur them and pay them.
Yeah.
And that certainly come through, and that was one of the drivers why we only set the 118.49 cents target in terms of our dips. So the interest line is certainly higher. We don't expect that to change meaningfully, and that's because we are still waiting for interest rate cuts to take place, and we're still bearing the effects of having those low interest rates and our hedges all resetting to these new current levels. But on our loan to value, you've seen it improve to the 42 and a bit percent. But I think there's a particular magic that should be happening soon, is that in our disposals that we've got contracted for, that is in excess of 2.4 billion rand. And when those proceeds come in, that's going to be a meaningful liquidity event for us, which at the base case would be used to reduce loan to value meaningfully from the 42% level down to the mid-30s. But we have certainly got plans to utilize that cash for further diversification, most probably offshore. So it'll trend back up there.
Well, thank you so much for your time and giving us insights and detailing those numbers that came out of Emira. That was CEO of Emira, Geoff Jennett.